Well, welcome to Chapter 12. We're getting near the home stretch of class, so just 3 chapters left. For this week, we're just talking about Chapter 12, though. And Chapter 12 is about S Corps. So kind of a lot of similarities to an LLC, but we'll explain the differences between an S Corp and a C Corp. There's a few that you will need to be aware of. So the big picture that they have us working on this week, and just right away, the first page of the chapter on page 1 is where they show this. This is for Cain Inc., and they've been a C Corp. They've earned taxable income of less than $100,000, and so the business has been subject to lower C Corp tax rates, which we all know are now 21%. Due to cheap imports from China, Cain's two owners, Smith and Jones, expect operating losses for the next 2 or 3 years. They hope to outsource some of their manufacturing to Vietnam to turn the company around, and then how can they deduct these anticipated future losses? So if you can kind of recall from C Corps, that's kind of one of the limiting factors of a C Corp is how much will they be able to deduct those losses. So that's kind of where their thinking is. If we're going to have losses, maybe the C Corp form is not the best form for us. The corporation also receives some tax-exempt income, generates a small amount of passive income, passive investment income, what they call PII, and holds some C Corp E and P. Remember, that stood for earnings and profits, loosely the same as retained earnings. Each owner draws a salary of 92. It has 2 classes of stock, a voting and non-voting common. Cain is in Texarkana, Texas. Smith is in Texas, and Jones lives in Arkansas. Okay, so the company itself is in Texas. Smith lives in Texas. Jones lives in Arkansas. Both are married to non-resident aliens. Should Smith and Jones elect to be taxed as an S Corp? And then we'll go through and figure that out. So the reason they give us some of this info right here is to help us identify some of the little rules we have to think about when it comes to the election of going from an S to a C. So that's really a lot of what the first part of the chapter is about. It's just kind of what makes an S Corp unique. Kind of why would that maybe be a choice that you would choose as you set up your business, and also just know that you can make switches between an S and a C quite frequently. And that's part of what they kind of talk about in the chapter also. So S Corps provide many of the same benefits as partnership taxation, so very similar to an LLC or an LLP. The S Corp status is obtained through an election by a qualifying corporation with consent of its shareholders. So it's just an election that you make with the IRS. S Corps are still corporations for legal purposes. So really, and the benefit is that you get that limited liability with the ability to raise capital, however, within some limits. So it's not a C Corp where you can, issue stock and have 1 million shareholders. It's not that. So there are some limits with how much you can sell and what the ability to raise capital is. And an S Corp is a pass-through, just like an LLC or LLP or any partnership. So an S Corp itself, it pays a few taxes because there's always some exceptions. But generally, the vast majority of income will flow through, just similar to the LLC stuff that we got done doing not too long ago, which is what they mentioned right here. So there will be, remember some of the LLC stuff, there was taxes that, or kind of income that was shared, business income and business expenses were shared. We accumulate what that is, and we share that, pass it on to whatever your percent of ownership is to your shareholders. Then we have those separately stated items. If you recall from an LLC, it's because we have to separately state those to the owners because each owner's tax situation may be a little bit different in terms of what their individual tax rate is and so on. So that's those separately stated items are just given that way to give the ability of the owners the ability to report the income correctly on their returns. So again, it's a reporting entity, not a tax-paying entity, except for a few little minor issues which will come up. I think I know for sure we'll look at a built-in gain problem And I think we have one that deals with PII, the passive investment income penalties. So we'll look at a couple of homework problems that will deal with some of those little exceptions. They're not difficult by any means, just be aware of them. S corps may not make a special allocation of tax items like a partnership can, and then distributions of appreciated property are taxable in an S corp situation. So that's one thing to kind of think through. Distributions of appreciated property are taxable. And then the entity is subject to subchapter C rules for a transaction unless a subchapter S rule provides some alternative rules. So when there's a doubt, we'll default to what the C corp rules are unless there's a specific separate S corp rule to think through. So why would I elect to go to an S corp? That's kind of what the big picture is, right? We've got a company that's been profitable, not super profitable, but profitable. But now with competition and cheaper imports, we expect to lose some money for a while until we kind of redo our business model and outsource some manufacturing overseas to Vietnam. So with that in mind, we anticipate some losses for a while. And with a C corp, it's really hard to take a benefit of a loss. You have to carry those forward and backwards. It's not the same. You can't use it in the exact same year that you incur it. That's different if it's an S corp though, and so that's kind of what they're thinking through. So it says if shareholders have a high marginal tax rate versus the C corp rate, that's one factor to think through. We expect there to be net operating losses. If currently a C corp, any net NOL carryovers from prior years can't be used during S corp years. So if we've got prior carryovers, we can't use those if we become an S corp. What's the character of anticipated flow-through items? What will those flow-through items be? How will they affect the owner's personal tax returns? Obviously, state and local laws and some other things too. But that in general, those are the big picture things to think through. So coming back to some more S corp qualifications, you have to do the following things to meet the requirements. So you must be a domestic corporation. Okay, so that's one of the hugest ones. So a C corp is not limited to that, but an S corp must be domestic. Must not otherwise be ineligible. And so ineligible S corps would be certain kinds of banks, insurance companies, and foreign corporations. So those would not have the option through IRS law or IRS rules or tax law to become S corps. They just don't have that option. Any domestic corp that's not an ineligible corp can be qualified as a subchapter S sub, what they call a QSSS, if the S corp owns 100% of its stock and is elected to treat the sub as a QSSS. So you can be a division of a C corp, could potentially be this QSSS. S corps can only have one class of stock. That's one major factor to consider also. Now, that one class of stock has some loose definitions to it, though. Can have stock with differences in voting rights, but not in distribution and liquidation rights. So you can have one class that has voting rights and one that does not, and still have one class of stock for this rule. It's possible for debt to be reclassified as stock, results in an unexpected loss of S corp status, and safe harbor provisions might mitigate that. But the biggest one to think through is this one right here. Can have stock with differences in voting rights, but not in distribution or liquidation rights. So that was the big picture scenario that they gave us. So returning back to the big picture, Kane could elect to be an S corp as long as the two classes of common stock are identical, except for the voting. One's voting, one's non-voting. If everything else is the same, then we're good. You learn that both shareholders have binding employment contracts with Kane. The amount to be paid to Jones under her employment contract is reasonable. The amount paid to Smith, though, is considered to be excessive, resulting in a constructive dividend. So remember, if it's excessive, then anything that you receive above the excessive amount, you treat as if it was a dividend, and you pay a dividend tax on that. Smith's employment contract is not prepared to circumvent the one class of stock requirement. Because employment contracts are not considered to be governing provisions, Kane can still is treated as though it has one class of stock if an S election is made. So even with these little extra things they threw at us, it's still considered to have one class of stock. Some other qualifications, you're limited with how many shareholders you can have. That's one big one. So generally, a lot of S Corps, and I've done the books for S Corps, have just been typically really small family-owned businesses. And small by really just kind of mean the number of owners. It's just been only members of the family. Think of parents and kids primarily. So it must have 100 or fewer shareholders. Okay. Family members may be treated as one shareholder, though, which could be important potentially depending on what you're trying to do with the company. Shareholders may include resident individuals, estates, certain trusts, and certain tax-exempt organizations. So resident individuals, U.S. citizens, okay, certain trusts and certain tax-exempt organizations. Charitable organizations, employee benefit trusts exempt from taxations, and one-person LLC classified as a disregarded entity can also qualify as S Corps potentially if they want to be. Partnerships, corporations, LLPs, most LLCs, and most IRAs cannot own S Corp stock. Okay, but S Corps can be partners in a partnership or shareholders in a corporation. Okay, so partnerships, corps, LLPs, and most LLCs cannot own S Corp stock. That's just a key thing to remember. The S Corp can be a partner in a partnership, though, or a shareholder in a corporation. So they can own corporate stock. Shareholders cannot include any non-resident aliens. Okay, that's a big one right there. So coming back to the big picture, Jones lives in Arkansas, which is a common law property state. So the reason that matters is if you are divorced, you know, who gets what. That's kind of what they mean by that. So being married to a non-resident alien spouse does not affect the S Corp selection or election because Arkansas is a common law property state. Okay. Smith, though, lives in Texas, a community property state. His non-resident alien spouse would be treated as owning half of his community property stock. Okay. So essentially the law says because they're married and because it's community property state, essentially his non-resident alien spouse owns half the stock, essentially. So an S election would not be allowed. So to qualify for an S status, Smith would have to move to Arkansas, or the spouse would have to move to Texas, becoming then a resident alien. Okay, so if they want to do that, I guess they have to make that decision. If that really is beneficial to the company, they've got to make some life choices there about where they live. So making the election to become an S Corp must make a valid election that's filed timely, and all shareholders must consent, everybody, to be effective for the current year. So you have some time to figure it out. So the good news is you've got a long time. You've got 75 days of the current tax year to figure it out. You know, the 15th day of the third month, March 15th, or filed in the previous year, you know, any time previous to that. So, you know, obviously, just think of we're in the 2018 tax year, getting done with it soon. And so really, I would have until March 15th of 2019 to decide if I want to make 18 election become an S Corp. You know, I've got that much time to figure it out because that's when I can accumulate all my information, gather my data, and determine which C Corp or S Corp makes the most sense for me, and then make the election. So with that consent, each shareholder owning stock during election year must sign consent. Okay, must sign the consent, must be able to obtain extension of time filing consent from the IRS. Only available only if Form 2553 is filed on a timely basis. So coming back to the big picture, making the election, suppose that in 18, Sherwood Smith and Jones decide to become an S Corp beginning on January 1 of 19. Since the C Corp uses a calendar tax year, the S election must be made anytime in 18 or by March 15 of 19. Any election after March 15 of 19 will not be effective then until the 2020 calendar tax year. Okay, so what if we want to terminate the election? So an S election remains in force until revoked or lost, but it can be terminated if shareholders owning a majority of shares voluntarily revoke the election. So a majority shareholders revoke it. So to go to S Corp, everybody has to agree, but to revoke it, only the majority has to agree. And again, they go with the 15th day of the third month of the tax year to be effective for the entire year. Otherwise, it's effective for the first day of the following year. New shareholders owning greater than 50% of the entity affirmatively refuse to consent to the election. And of course, then if somebody says, no, we don't want this, or the entity no longer qualifies as an S Corp. If an S Corp fails to qualify as a small business corporation at any time after election has become effective, its status as an S Corp ends. For example, the entity has more than 100 shareholders, or a non-resident alien shareholder becomes a part of a shareholder, or a second class of stock has now been issued. So doing any of those things would terminate this. So election is terminated on date of disqualification. So if you do any of those things, you sell some stock and you have more than 100 shareholders, you accept a non-resident alien shareholder, or you create a second class of stock, you've essentially said we don't want to be an S Corp anymore. The Corp does not meet the passive investment income limit. So PII, passive investment income. If an S Corp has C Corp, E&P, earnings and profits, and passive income greater than 25% of its gross receipts for 3 consecutive years, the S selection is terminated at the beginning of the 4th year. It applies to S Corps that were previously C Corps, or for S Corps that have merged with a C Corp. Okay. So only if an S Corp that was prior to a C, or an S Corp that merged with a C. A new S election normally cannot be made within 5 years after termination, so you have to wait 5 years. Unless, there's always those unlesses, 5-year waiting period is waived if there's a greater than 50% change in ownership after the first year termination is applicable, the event causing termination was not reasonably within control of the S Corp or its majority shareholders. So there's always a few what-ifs. Okay, so next then is how do we calculate or compute taxable income? Very similar to partnerships, so a lot of the same work you did for the LLCs and the partnerships would still hold true here, except S Corp can amortize organizational costs under C Corp rules. S Corp must recognize gains but not losses on distributions of appreciated property to shareholders. So that's a little bit unique one. Okay, that one's a little bit different. And then certain other C Corp provisions that extend to C Corps, primarily the dividend receipt deduction, the DRD. So S Corps don't get the DRD. S Corp items are divided into, and this is exactly the same as LLCs, non-separately stated income or loss, essentially constitutes subchapter S, ordinary income or loss. Separately stated income, loss, and deductions credits that could affect tax liability of shareholders in some different manner. Okay, so this is really just the same rehash as LLCs. And this is a good summary of what all those are, the flow through. So we've got the corporate level, and we've got the things that would be common for all shareholders of the corporation. And you can see ordinary income, trade or business expense, and depreciation recapture is treated the same, but then we get to these separately stated items, so after the corporate veil. So all these items down here are computed more at the shareholder level, and they are separately reported so the shareholders know what their portion is to put that on their individual returns. So this same chart that you see right here is on page 11. So just kind of make a note that page 11 has the same information. So this is just a good list of the separately stated items right here. They should look familiar. And then the QBI. So one thing to note, the vast majority of this chapter is very similar to previous tax years. So even with the tax laws that were signed into effect in December of a year ago, the vast majority of this chapter is actually not changed. The only real significant change is the QBI. So remember, QBI is a brand new item introduced with the latest tax law. And I think the very first chapter we looked at, chapter 2, was pretty much all about QBI and what that was about, why it was incorporated, and so on. But remember, the goal was to pass tax savings on to everybody. And the corporate tax rate came down from the mid to upper 30s down to 21% for all corporations. So Congress wanted to pass that same benefit on to pass-through entities. So the pass-throughs being partnerships, LLCs, LLPs, and S corps. And so to give that benefit of being an S corp, the pass-through benefit became the QBI. Okay, so there's a little bit about the QBI then on page 12. There's a good chart there of that explains. I think it does a little bit better on page 12 than it does on this slide about what the QBI is and all that good stuff. So take a look at page 12, and we'll work a problem that deals with it also. Okay, so remember that in general, the from AGI, adjusted gross income deduction for QBI, is the lesser of 20% of QBI, qualified business income, or modified taxable income. The QBI is the ordinary income less ordinary deductions from a qualified trade or business. Okay, so just FYI. And then there's a limit on that, though. So then the limit is taxable income before the QBI deduction is more than 315, which is married filing jointly, or 157.5 for everybody else. And the QBI deduction cannot exceed the greater of 50% of W-2 wages, basically just wages paid to your employees, or the sum of 25% of W-2 wages relating to the qualified trade or business, and 2.5% of the unadjusted basis of all qualified properties. So the sum of those two things. And the limit is phased in over 100,000 or 50,000, depending if you're married or everybody else. Okay, so just a few little rules to think through. So it kind of just takes you back to when the class first started and we had all the QBI stuff. So then allocation of income and losses, very similar to what we did for LLCs and partnerships. Everybody gets their prorated share of non-separately stated income or loss, and then all their separately stated items. If the stock holdings change during the year, the shareholders allocated a prorated share of each item for each day the stock is owned. So if their percent change of ownership went up or down during the year, we have to factor that in day by day. And then we have what's called a short year election. It's on page 14. Is available if a shareholder's interest is completely terminated through disposition or death. So just be aware of that. Okay, then we talk about distributions. So we talked about distributions from LLCs and from corporations. Now we're just talking about distributions from S corps. Generally, the rules are fairly the same. There's a lot of consistency between them, so I think you'll recognize that as you look through these slides, read through the chapter, and as we work the problems together. I think you'll recognize a lot of similarity. So the amount of distribution to a shareholder is cash plus fair market value of any other property distributed. Taxation of distribution depends on whether S corp has accumulated E&P from its C corp years. So for any S corp that was a C corp previously, then we got to worry about the E&P concept. And then where no earnings and profits exist, it's non-taxable to the extent of basis. So remember that when you receive distributions, you reduce your basis. Your basis doesn't go down to zero, though. So anything above basis is treated typically as a capital gain. Okay, so now where earnings and profits exist, and this is kind of most of where the homework problems are going to come from in the chapter. Is a lot of will deal with distributions. So just be aware of that. Kind of starts on page 15, and there's a really handy summary on the bottom of page 15. It's called Concept Summary 12.2. So it talks about where there are no earnings and profits versus where earnings and profits do exist, and kind of what the rules are and kind of the order of things that you go through. So, and that's the exact same thing that's on this screen right here. So very bottom of page 15. So where earnings and profits exist, tax-free to the extent of the accumulated adjustments account, distributions from AEP constitute dividend income, tax-free to the extent of other adjustments account, tax-free reduction in basis of stock, and excess treated as a gain from the sale or exchange of stock, capital gain in most cases. So little asterisks here, the single asterisk right here. Once stock basis reaches zero, any distributions from the AAA, the accumulated adjustments account, is treated as a gain from sale. And the AAA bypass selections is available for the double star right here, and the AEP is accumulated earnings and profit. Okay, so bottom of page 15 is kind of where they talk about this. So we'll do some homework problems that'll hopefully make this more easy to understand. So the AAA, again, is on page 15, represents the cumulative total undistributed non-separately and separately stated items, and then mechanism to ensure that earnings of an S Corp are taxed to shareholders only once. So S Corp distributions, this is just a good exhibit to kind of think through here and be aware of when it comes to your homework. So this is, and that's wrong. It says exhibit 12.1. It's actually 12.3. It's on page 16 of your chapter. So the AAA, adjustments to the corporate AAA, increased by schedule income items, non-separately computed items, and depletion in excess of basis in the property, decreased by negative Schedule K adjustments, and any portion of distributions considered to be tax-free. Okay, so just be aware of that. Then other issues regarding distributions. Distributions of cash during a one-year period following S election termination receive special treatment. So 1 year after the S election termination, okay, so that's the key here, treated as a tax-free recovery of stock basis. Since only cash distributions receive the special treatment, the corporation should not distribute property during that period. Other issues, if E&P exists, the entity may elect to first distribute E&P before reducing AAA, called the AAA bypass election. Okay, so that's just in that first year after terminating the S Corp status. Okay, then we have distributions of property. So this is coming out of distributions of cash. If an entity distributes appreciated property, gain must be recognized. Okay, that's the key right here. Gain must be recognized. Treated as if the property was sold to shareholder for fair market value. Gain is allocated to shareholders and increases their basis in the stock before considering the distribution. Basis of asset distributed becomes the fair market value. A loss is not recognized. The basis of asset distributed is the FMV, fair market value. Essentially, a lost property receives a step down in basis without any loss recognition by the S Corp. Okay, so don't do that. so avoid doing that if you can, would be the rule. Sell it instead, right? Always just, whenever you see that, the corporation should sell it to realize the loss. We will have a homework problem that'll deal with this one too. So determination of initial basis is similar to the stock of a C Corp. It really depends on the manner the stock was acquired, inherited, purchase, or exchange. The basis is increased by purchases, capital contributions, non-separately computed income, separately stated income, and depletion in excess of basis. Basis is decreased by distributions not reported as income, non-deductible expenses, non-separately computed losses, separately stated losses, and very similar to the partnership rules. The shareholders' basis cannot be negative. I think I've mentioned that once before. Once basis is reduced to zero, any additional reductions decrease the basis in loans made to the S Corp. So if the shareholder has loans made to the S Corp, you can reduce those. Any excess loss or deductions are suspended, and once base of debt is reduced, it's increased by subsequent net increases from all positive and negative adjustments. The basis rules are very similar to partnership rules, except partner's basis in partnership interest includes direct investment plus ratable share of partnership liabilities, except for loans from shareholder to the S Corp. Okay, so treatment of losses. We allocate total loss to the shareholder on a daily basis based upon stock ownership. If the shareholder's loss exceeds stock basis, apply any excess of adjustment basis of indebtedness to the shareholder. And where losses are greater than the debt basis, excess is suspended and carried over future tax years. In addition, in future tax years, any increase in basis adjustment restores debt basis first up to the original amount. Once debt basis is restored, remaining net income is used to increase the stock basis. Suspended loss from previous years now reduces the stock basis, and then if S election terminates, any loss carryover remaining at the end of the post-termination transition period is lost forever. So a lot of little steps there to think through when it comes to the basis and the basis rules. So it's a lot to remember clearly. So, but just be aware that you may need to refer back to that when it comes to some of your homework problems. So coming back to the big picture, Smith and Jones make the S election for Kane. They will be able to pass through any NOLs to the extent to the shareholders' adjusted stock basis. If in the new S Corp incurs an NOL of 84 during the year, both can deduct $42,000 against other income for the year in which Kane's tax year ends. Any NOL incurred before S election is in effect does not flow through to the shareholders because it just can't. It has to stay at the C Corp. S Corp shareholders are limited to the amount of losses they may deduct by their at-risk amounts. Determining at-risk amount is somewhat similar to partnership at-risk rules, okay, and it has to be determined separately for each shareholder. The amount of corporate losses that are passed through and deductible by shareholders is not affected by the amount of corporation has at risk. And then passive losses and credits. An S Corp is not directly subject to passive loss rules. If the Corp is involved in rental activities or shareholders do not materially participate, passive losses and credits flow through to shareholders, and the shareholder stock basis is reduced if passive losses are not currently deductible. And the built-in gain tax generally applies to C Corps converting to S Corp status. Corporate level tax on built-in gain recognized in the taxable disposition within 5 years after effective date of the S Corp election. So within 5 years this applies. The tax basis includes unrealized gain on appreciated assets held on date of S Corp election. The highest tax rate applies for corporations, which is 21%. And the gain passes through to shareholders as taxable gain. Has maximum built-in gain recognized over the required 5-year period limited by the aggregate net built-in gain at the time it converts to an S Corp. The amount of built-in gain recognized in any year is limited to an as-if taxable income computed as if the Corp were a C Corp. Okay. S Corp can offset built-in gains with unexpired NOLs or capital losses from C Corp years. Okay. And the reason that exists is so that you can't just switch from a C to an S and then distribute appreciated property to an owner and avoid capital gain tax. So remember that when you're a C Corp, you have double taxation, and so you can't switch to an S Corp just to avoid the double taxation. So they're giving you 5 years. You have to wait 5 years to avoid that, essentially, is what they're saying. So the purpose of that is just to keep companies from switching to C to S to avoid double taxation, distribute some appreciated property to an owner, then switch back to a C Corp. So just preventing that from happening. Then LIFO recapture. Any LIFO recapture amount at time of S Corp election is subject to corporate level tax. Taxable LIFO recapture amount is the excess of inventory's value under FIFO over LIFO value, and resulting tax is payable in 4 annual installments. And then computation of built-in gains tax. Select the smaller of built-in gain or taxable income. Deduct unexpired NOLs. multiply the tax base from step 2 by the corporate tax rate, which would be the 21%. Deduct any business credit carry forwards and AMT credit carryovers, and then the corporation pays any tax resulting from step 4. And the big picture, built-in gain tax from the big picture, if Kane becomes an S, a built-in gain may be recognized. Assume that Kane reports a $50,000 built-in gain on a conversion. It holds a $20,000 NOL carry forward from its C Corp years before the S election. The NOL carry forward can be applied against the built-in gain. The built-in gain then only becomes $30,000. And then also, if an S Corp has accumulated E&P from the C Corp years, a tax is imposed on excess net passive income. Calculation is as follows. So passive investment income, which is greater than 25% of gross receipts, divided by passive income, investment income for the year, is multiplied by net passive income for the year. So we're kind of just separating it between those two chunks, multiplied by the net passive income for the year. Passive investment income includes royalties, rents, dividends, interest, annuities. Only net gain from disposition of capital assets is included. And excess net passive income cannot exceed C Corp taxable income before considering NOL or special deductions. And again, we use the highest corporate tax rate, which is 21%. So coming back to the big picture, now we'll look at salary versus distribution. The two shareholders should consider reducing your $92,000 salary and instead receive a larger undistributed share of the S Corp income. It says here a shareholder's share of pass-through S Corp income is not treated as a self-employment income, whereas compensation is subject to Social Security tax, Medicare tax, the corporation, and both employees. As long as Smith & Jones, the owners, maintain C Corp status, they cannot deduct any NOLs from the business on their individual returns. For the owners to deduct any NOLs on their personal 1040s, Kane needs to be operated as a flow-through entity, obviously, which makes sense to be an S Corp. The S election may be appropriate. So if they do that, of course, they have to form the Form 2553, and both shareholders must consent and make the election before the 15th day of the 3rd month of the current year. Normally, an S Corp does not pay any income tax. A C Corp making S election may be required, though, to pay the built-in gain tax or the LIFO recapture tax. So those are kind of the only two exceptions to that. An S Corp can have voting, non-voting common stock, provided all shares have the same economic rights. Basically, sharing income and losses the same. Kane might sell off bonds that generate tax-exempt income, which will not be reflected in the AAA. Although it is reflected in stock basis, tax-exempt income is distributed to the shareholders only after the S Corp has distributed all of its C Corp E&P. Also, what if non-resident aliens cannot own S stock, so joint ownership of the shares is desired? Residency must change, obviously. When Kane begins to turn a profit, the S election will be less attractive, and they may terminate that, and go back to the C Corp where they're 21% taxed. Okay. So lots going on there, but I think you'll discover there's a lot of similarities between this and the LLC stuff that we've learned previously. So I think you'll recognize that, and hopefully it won't be too bad as you work the homework problems. As always, if you have questions, just let me know. Thanks.